Welcome to our webinar series on New Jersey tax reform. My name is David Katowski and I'm joined by Matthew Setzer. We're lawyers with Reed Smith State Tax Group, which has over 40 lawyers, CPAs, and paralegals nationwide who do nothing but state tax. We've got 15 lawyers licensed to practice in New Jersey, which makes us one of the largest New Jersey tax practices of any law firm. In this episode, we're going to discuss corporate partners and how their corporation business tax, or CBT, is going to be affected by New Jersey's new combination provisions. New Jersey switched from separate company to combined reporting last year, and it goes into effect now in 2019. But before we get into the new rules, let's start with some of the history. So historically, New Jersey wouldn't assert nexus over corporate limited partners if their only connection to the state was their interest in the limited partnership doing business in New Jersey. This policy was based in part on an old Attorney General opinion, and through most of the 1990s, the division applied a presumption that a corporate limited partner would be non-unitary with the underlying partnership. But then things started to shift by the early 2000s. New Jersey didn't want to let partnership income escape taxation completely, but it still had some doubt about whether limited partnership interest alone could create nexus. So instead of taxing all out-of-state limited partners directly, it imposed a withholding tax on partnerships that had non-unitary partners that were located outside the state. Now, if the corporate partner conceded nexus and then filed a return, you could get a credit for any tax withheld on its behalf. But otherwise, New Jersey would be assured of getting at least some income or tax on the income from the partnership. So then along comes this case called BIS. This involved a taxpayer that was a holding company and had just one asset, a 99% limited partnership in a New Jersey partnership. The taxpayer's parent corporation was the 1% general partner, and the taxpayer argued that it was just a passive investor and that it was non-unitary with the underlying partnership. In some bit of a surprise, I think, to most practitioners, the tax court agreed. The court concluded that the taxpayer lacked nexus with New Jersey, and importantly, that the taxpayer was entitled to a refund of any tax paid on its distributive share. So there was a series of appeals in that case, and then some other cases that involved different taxpayers with similar fact patterns. But the bottom line is this: if you were a corporate limited partner and non-unitary with a partnership, there was no tax on your distributive share as long as you had no other connection to the state. So the division essentially loses in the courts, but it has the ear of the legislature. So that brings us to the new rules that were enacted last year. Matt, why don't you tell us what happened?
Sure. So as part of New Jersey tax reform and the legislature's adoption of combined reporting, New Jersey also adopted a new test for what it means to conduct a unitary business. And unless you and any commonly controlled affiliates own more than 50% of a partnership, you can't be unitary. So cases of a 50-50 joint venture, by definition, are not unitary with the partnership. On the other hand, even if you only have a 1% interest, you still might be unitary depending on if your affiliates own any additional interest in the partnership. But just because you directly or constructively own more than 50% of the partnership, that doesn't necessarily mean you're unitary. There still must be interdependence, integration to provide synergy, mutual benefit, and flow of value. These are all the things that the Supreme Court has looked to in determining what is a unitary business.
Now, the statute hasn't really provided any more details than what you just said, but the division did just release a new tax bulletin.
Yeah, the division just issued a tax bulletin that's consistent with the statute. So the statute says that the legislature allows the division to interpret the unitary business principle to the broadest extent of the United States Constitution. So in a technical bulletin that the division released, it just basically breaks down all the Supreme Court cases and provides all the factors that the Supreme Court has looked to in determining whether there is a unitary business in those cases. So that's what the technical bulletin is. It's just a regurgitation of those factors.
So we can expect to see a bias, you think, towards finding a unitary business, I guess, except for one very important bright line part of the test.
I think that's correct. And that's the bright line part of the test that we mentioned already, that you have to have more than 50% ownership in the partnership, if we're talking about partnerships, for there to be a unitary relationship.
Okay, so if you have 50% interest or less, what happens if you're unitary with a partnership?
So under the new rules, the partnership business is treated as if it were conducted directly by the corporate partners. Partners have to flow up their distributive share of their partnership's apportionment factors and credits. And this last point is pretty important for certain taxpayers. The division's prior policy was to flow up partnership factors and credits based on your capital percentage. We've had appeals on that where we've had to defend assessments based on whether you flow up based on capital or income percentage. The new statute makes it pretty clear that your income percentage is what matters.
Okay, so that's the rule. If you're unitary, you flow up the income and the factors from the partnership. What happens if you're non-unitary? If you're a general partner with only a 50% interest or less, then you're non-unitary under the bright line test. But you'll still have nexus. That's because the activities of a partnership are attributed to its general partner. So if the general partner has a brick and mortar office in New Jersey, the general partner has to file a return and pay tax on its distributive share. Because the general partner is considered non-unitary, it computes its tax using the separate accounting method. In other words, the partner's distributive share is apportioned using the factors of just the partnership. And any income the general partner has apart from the partnership is apportioned using the partner's separate company factors. So if the general partner doesn't have a brick and mortar office in New Jersey, the partner doesn't have to file a return. It won't have nexus based on its interest in the partnership. But the partnership will have a filing requirement, and it will have to pay tax on behalf of the general partner. But the tax due is the same regardless of whether it's paid by the partnership or directly by the general partner. In both situations, the separate counting method applies. If a limited partner has more than a 50% interest, it'll be treated as unitary. It'll be required to use the flow-through method. That means that any tax on its distributive share will be computed by flowing up the factors for the partnership and combining them with the factors of the partner. The tax is paid by the partner itself or by the managerial member on the combined return rather than being withheld by the partnership. Where things get weird is when you have a non-unitary limited partner. Again, New Jersey now has this bright line definition of what a unitary business is. And if you have no more than a 50% interest in a partnership, you're automatically treated as non-unitary. If the non-unitary limited partner has a brick and mortar office in New Jersey, but its commercial domicile is outside the state, there's no tax due on the partner's distributive share. That's a key takeaway. None of the limited partner's distributive share is going to be subject to New Jersey corporate business tax. And here's why. The partnership doesn't have to withhold tax because the partner has nexus and files its own return. But on that return, the partner can treat its distributive share as non-business income and source it or assign it entirely to its commercial domicile. So if your commercial domicile is outside New Jersey, great news, no tax is due. Of course, if you're domiciled in New Jersey, your tax is going to increase under the new rules because 100% of your distributive share will get assigned to New Jersey. So another takeaway, if you have a 50% or less interest in a partnership, you want to make sure that that partner does not have a commercial domicile in New Jersey. Things get even stranger if the limited partner doesn't have a brick and mortar office in the state. If a partner doesn't have an office in New Jersey, it's considered a non-resident, and the statutory withholding rules kick in. The partnership now has to withhold tax on the partner's distributive share, and under the statute, the distributive share gets apportioned using the factors of the partnership itself.
Now, all of this is consistent with recent division determinations as well. So even prior to the change in combined reporting, it seems like this was the division's policy.
Right. Now, we just have it kind of laid out in a statute. I mean, the big part of the new statute is this bright line rule. That's really going to affect how you're going to get treated. So the problem with the new rule is that it violates the Constitution. And the reason is because a non-unitary limited partner that has an office in the state, but its headquarters outside the state, doesn't have to pay any tax on its distributive share. Again, the reason because it's going to treat its distributive share as non-business income, and it's going to assign it to its commercial domicile. So you can't impose tax where the situation is identical, except that the partner doesn't have an office in the state. Conditioning the tax on whether a partner does or doesn't have an office in New Jersey would discriminate against interstate commerce. So does this mean that you can just ignore the statute? We think so. Right? I mean, we think so, but you should
Does the
expect
division.
Right. So you should expect the division to take the opposite position. So if you do take this position on your return, you may have to defend yourself against potential tax assessments. So we went through a lot of detail here. There's a lot of different permutations. So to wrap things up, why don't we provide a quick summary of what the rules are. Matt, what are the main points here that taxpayers should take away?
Sure. First, general partners, if you own more than 50% voting control, you're unitary, and you simply flow up the income and factors of the partnership. If you own 50% or less, you'll need to file a return, but your distributive share is taxed using the apportionment factors of the partnership itself. Second, limited partners with greater than a 50% interest in the partnership. In general, the division will take the position that you're unitary and treat the business of the partnership as conducted by the partner itself. The partner has nexus, and the partnership income and apportionment factors flow up to the partner based on the income percentage in the partnership, not the capital percentage. And finally, limited partners with a 50% or less in a partnership. Their distributive share is either taxed 100% by New Jersey or not at all, depending on your commercial domicile. The statute says that the partnership has to withhold tax based on the partner's office in New Jersey. Once again, we feel that this is discriminatory and violates the Commerce Clause of the U.S. Constitution, so you can ignore that withholding requirement and either take a return position or pay the tax at the partnership level and file a refund claim.
It really depends on your appetite for risk and assessment. So that concludes our program. Thank you for joining us, and if you have any questions, or need a copy of any of our materials or our New Jersey Tax Reform Survival Guide, please call or email us. And check our website for additional programs involving combination. Thank you.